What is the reality behind market symbols, prices, numbers, and graphs? When you check prices in your newspaper, watch quotes on your screen, or plot an indicator on your chart, what exactly are you looking at? What is the market that you want to analyze and trade? Amateurs act as if the market is a giant happening, a ball game in which they can join the professionals and make money. Traders from a scientific or engineering background often treat the market as a physical event. They apply to it the principles of signal processing, noise reduction, and similar ideas. By contrast, all professional traders know full well what the market is. It is a huge mass of people. Every trader tries to take money away from other traders by outguessing them on the probable direction of the market. The members of the market crowd live on different continents. They are united by modern telecommunications in the pursuit of profit at each other's expense. The market is a huge crowd of people. Each member of the crowd tries to take money away from other members by outsmarting them. The market is a uniquely harsh environment because everyone is against you and you are against everyone. Not only is the market harsh, you have to pay high prices for entering and exiting it. You have to jump over 2 high barriers, commissions and slippage, before you can collect a dime. The moment you place an order, you owe your broker a commission. You are behind the game before you begin. Then floor traders try to hit you with slippage when your order arrives on the floor. They try to take another bite out of your account when you exit your trade. In trading, you compete against some of the brightest minds in the world while fending off the piranhas of commissions and slippage. Private traders usually come to the market after a successful career in business or in the professions. An average private futures trader in the United States is a 50-year-old, married, college-educated man. Many futures traders own their own businesses, and many have postgraduate degrees. The 2 largest occupational groups among futures traders are farmers and engineers. Most people trade for partly rational, partly irrational reasons. Rational reasons include the desire to earn a large return on capital. Irrational reasons include gambling and a search for excitement. Most traders are not aware of their irrational motives. Learning to trade takes hard work, time, energy, and money. Few individuals rise to the level of professionals who can support themselves by trading. Professionals are extremely serious about what they do. They satisfy their irrational goals outside the markets, while amateurs act them out in the marketplace. The major economic role of a trader is to support his broker, to help him pay his mortgage and keep his children in private schools. In addition, the role of a speculator is to help companies raise capital in the stock market and to assume a price risk in the commodities markets, allowing producers to focus on production. These lofty economic goals are far from a speculator's mind when he gives an order to his broker. Institutions are responsible for a huge volume of trading. Their deep pockets give them several advantages. They pay low institutional commissions. They can afford to hire the best researchers, brokers, and traders. Some even strike back at floor traders who steal too much in slippage. The spate of arrests and trials of Chicago floor traders in 1990 and 1991 began when Archer Daniels Midland, a food processing firm, brought in the FBI. A friend of mine who heads a trading desk at a bank bases some of his decisions on a service provided by a group of former CIA officers. They scan the media to detect early trends in society and send their reports to him. My trader friend culls some of his best ideas from these reports. The substantial annual fee for those experts is small potatoes for his firm compared with the millions of dollars it trades. Most private traders do not have such opportunities. it is easier for institutions to buy the best research. An acquaintance who used to trade successfully for a Wall Street investment bank found himself in trouble when he quit to trade for himself. He discovered that a real-time quote system in his Park Avenue apartment in Manhattan did not give him news as fast as the squawk box on the trading floor of his old firm. Brokers from around the country used to call him with the latest ideas because they wanted his orders. "When you trade from your house, you are never the first to hear the news," he says. Some large firms have intelligence networks that enable them to act before the public. One day, when oil futures rallied in response to a fire on a platform in the North Sea, I called a friend at an oil firm. The market was frantic, but he was relaxed. He had bought oil futures half an hour before they exploded. He had gotten a telex from an agent in the area of the fire well before the reports appeared on the newswire. Timely information is priceless, but only a large company can afford an intelligence network. The firms that deal in both futures and cash markets have two advantages. They have true inside information, and they are exempt from speculative position limits. Recently, I visited an acquaintance at a multinational oil company. After passing through security that was tighter than at Kennedy International Airport, I walked through glass-enclosed corridors. Clusters of men huddled around monitors trading oil products. When I asked my host whether his traders were hedging or speculating, he looked me straight in the eye and said, "Yes." I asked again and received the same answer. Companies crisscross the thin line between hedging and speculating based on inside information. Employees of trading firms have a psychological advantage. They can be more relaxed because their own money is not at risk. Most individuals do not have the discipline to stop trading when they get on a losing streak, but institutions impose discipline on traders. A trader is given two limits: how much he may risk on a single trade, and the maximum amount he may lose in a month. These limits work as stop-loss orders on a trader. With all these advantages, how can an individual trader compete against institutions and win? First, many institutional trading departments are poorly run. Second, the Achilles heel of most institutions is that they often have to trade, while an individual trader is free to trade or stay out of the market. Banks have to be active in the bond market, and food processing companies have to be active in the grain market at almost any price. An individual trader is free to wait for the best trading opportunities. Most private traders fritter away this advantage by overtrading. An individual who wants to succeed against the giants must develop patience and eliminate greed. Remember, your goal is to trade well, not to trade often. Successful institutional traders receive raises and bonuses. Even a high bonus can feel puny to someone who earns many millions of dollars for his firm. Successful institutional traders often talk of quitting and going to trade for themselves. Most traders who leave institutions get caught up in the emotions of fear, greed, elation, and panic when they start risking their own money. They seldom do well trading for their own account. Another sign that psychology is at the root of trading success or failure.